Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the TGI Friday. Thank God it's Friday the 28th of January webinar, the Bull versus Bear webinar here with Steve Miley on the call for TradeDay.com. So welcome everyone. For our usual regular run through in today, calendars, macro calendar, fundamental calendar, what are the major data economic releases we're seeing globally, but also with more of a focus on the US, since we're mostly looking at US clients and US markets and global markets in here. So we're going to keep an eye on the US calendar, but we're looking at global calendar as well. We'll take a look at the earnings calendar, very much focused on the US earnings, because they're the ones that are going to impact onto the US equity indices, which we are trading here at Trade Day. And then we'll also take a look at the macro fundamental articles from the major news wires, from Bloomberg, from Reuters, see what's going on in the market right here, right now, see what's impacting financial markets. Pretty much the same kind of stuff that we've been talking about throughout this week and for the last week or two in here. So nothing really massively new to add, but we'll run through those again anyway, and then we'll take a look at some charts and see what's going on. It's going to be a fairly brief webinar, very little to add to what we've been talking about in here last few days, in fact anything for the last week plus in here. So on the macro side in here, we have had some data out of Europe, actually. French GDP beating expectations in here yesterday, similar to the US GDP, where had a substantial beat yesterday. So showing the ongoing strength in the recovery in the post-pandemic world in here. Markets still very, very strong, or economies still continuing to rebound. We do get in here PCE data in here. We did get some PCE data, further PCE data out of the US today. That comes in just under 1 hour. So that is, you're in London, if you're in the UK, not in London, if you're in the UK, sorry, GMT. We are talking at 1:30 p.m. GMT, 2:30 if you're in Central Europe, if you're in Europe. And then if you're on the East Coast, so Eastern Time US, we're talking 8:30 in just under 1 hour's time. And if we are in Chicago, or if you're in the Central Time, we are looking at 7:30. So yeah, we've got that coming up. That could be impactful. Remember the PCE, the price index in here, also including the employment cost index. All of this PCE data, this is what Fed tells they look at, right? That's what one of their main measures of inflation. So we're certainly keeping an eye open for that. Don't forget today as well, this is often overlooked, Michigan consumer sentiment data in here. We get that at 10 o'clock Eastern time, so 1.5 hours after that, 10 o'clock Eastern time. So watching out for that. That can sometimes impact markets, but I'm thinking probably not, given the volatility we're seeing particularly across stock indices in here at the moment. Let's take a look at the earnings calendar. So I've already filtered this down. So for today, we've got Chevron, Caterpillar, probably the standout two, already released in here today. So those are already out. And so you can see Chevron in here, and both Chevron and Caterpillar beating expectations on the revenue side, and just a mixed bag in here. So Chevron significantly missing on the EPS, the earnings per share, but Caterpillar beating. Caterpillar often seen as a bellwether for really for the whole US economy, but certainly for the whole construction industry in the US. So obviously that's still looking fairly strong in here. But at the moment, really there is an extent that strong economy is not good for stocks, perversely. I know it sounds counterintuitive, but strong economy means that more likely to be a more hawkish stance from the Fed and from global central banks, and then that means that's what's been putting stocks under pressure for the whole of this year. The more hawkish tone from the Fed, alongside the political and potential conflict, the tensions that we have around Ukraine, Russia. So, but one of the really the big driver has been the more hawkish Fed in here, and we've certainly seen whipsaw price action throughout this week in the wake of the Fed meeting on Wednesday. Yeah, I mean, I don't think we've got nothing really coming out today. If we go back though, just looking back to yesterday, so we did have after the bell Apple, a huge beat on Apple. There has been concern after we had the very strong Tesla data earlier this week. There was guidance about from Tesla though, and Tesla has subsequently sold off, and that sell off in Tesla because of the guidance on concerns around the chip shortage, concerns around supply chain worries in here. So that saw Tesla lower. Now, Apple did give in their last quarterly report, earnings report, they did give guidance about concerns about chips, concerns about supply chain issues, but that's seemingly not coming through in here with the data. So the earnings data in here significantly beating, and the revenue significantly beating expectations for Apple. Apple shot up higher last night after the close, and actually led the whole tech sector higher after a fairly weak close on Wall Street yesterday, on Thursday, and after the bell we had the Apple data come out, the Apple earnings report, and that lifted markets. So we saw a significant rebound, but then since then markets have dipped back lower. Let's take a look at some of the macro fundamentals that we've got in here. So we'll look at the 5 things to start your day in here. Rate hike in March, fully expected now. 1 in 5 chance of up to 50 basis points now, a half point, which is not really being expected. We've been expecting, and in previous rate hikes, in previous cycles, the Fed have tended to go for 25s, moving up in quarter percent as they go. But as we said yesterday, 5 Fed hikes now, pretty much getting priced in. Apple, we've already spoken about this, highest ever quarterly earnings, beat Wall Street expectations, and then the outlook, the forward guidance as well. So double-digit sales growth in the current quarter, and Apple shares up 4% still. So they're still doing pretty well. Biden in here, repeat a warning to Russia, a warning that Russia may invade, and then the Kremlin continues to deny that. There is a little bit of a disparity between how Europe is approaching this and how the US is approaching this, and oil is benefiting that, oil hitting another new multi-year highest level since 2014 because of concerns about oil prices, because of that tension. And in here, markets, VIX in here. So remember, the VIX is the volatility index on the S&P 500. The VIX index is still very high, and that's because of the absolutely aggressively whipsaw price action. Markets very, very difficult. The stock indices, even, sorry, more than not generally markets, but the stock indices very, very difficult to trade in here. Generally, we're seeing a bid. The markets have been relatively well bid since the big sell-off that we saw through middle to later January and on Monday. Then we've had that turnaround rebound. But most of the sessions in the Asian and European sessions, markets have been bid, and most of the times, and by bid I mean they look strong. They look like they're going to recover. And for much of the US sessions, they've also been relatively strong. But we've seen some big sell-offs throughout the US sessions, and then particularly the closes have been particularly weak in here. So although it seems there's been buyers coming through the day, and there's no appetite for buying, we've seen further liquidation pressures coming on the close. Now, maybe a lot of those liquidation pressures are finishing here. Day trading this has been very difficult. My main piece of advice here would be don't get tied to a position. I would be, if you're a swing trader, which if trade day, you can't have those swing trades on because you're obviously playing this and closing out each day, so you're playing it from a day trade perspective. But a swing trader perspective, for me, I'm looking at the market and thinking, well, this looks like it's a base for me. We've had a lot of bad news, and I spoke about this yesterday. A lot of bad news already priced into the markets. 5 rate hikes. The market now starting to price in risk of a March 50 basis point, 0.5% rate hike. So the market's already factoring on those negatives. The market's already factoring in a lot of negatives around the Russia-Ukraine situation. But they are going down a diplomatic route at the moment, and maybe Putin gets what he needs on a diplomatic basis. Okay, so there's a lot of negativity priced in. The markets are trying to rebound, and we'll look at the charts shortly. And we looked at the charts over the last couple of days. We're seeing like a base is trying to form on the major stock equity indices in here, on the S&P 500, on the Nasdaq. Markets are dipping lower, but then rebounding strongly. But then equally, the closes each day are have been fairly negative. So my advice is not to get tied to positions. I'm still, from my perspective, I still think you play it from the long side. I think they're more defined, particularly if you've got a really obvious exit stop below point. But then equally, don't look for too much on the upside. If you get a decent profit, now these things are moving very, very quickly. Trail the stop, move the stop as you go into profit, bring the stop up as well, because the markets at the moment, they're rallying 1.5%, 2%, and then dropping back 2%. So trail that stop up quickly as you get into profit if you're playing it, particularly from the long side. If you then flip and go short, if the market starts to sell off, particularly if it's going into the closes, trail the stop down as well, because then in aftermarket, we've seen some quite vicious rebounds in the aftermarket as well. So it's about being really flexible. It's about having tight stops. It's about moving those stops, kind of quickly and booking in profits within the day. You have to be very agile in here at the moment. It's not a matter of buy and hold through the day and sell at the end of the day, or sell and hold and then buy back at the end of the day. Markets are, we're seeing maybe 2-3 different directional movements within the day. Okay, and hence that's why the VIX, the volatility index, is significantly higher than usual. As well as we spoke about the PCE reports as well, and we get University of Michigan. We've already spoken about that, and we've seen the data is already out from Chevron and Caterpillar. Okay, let's take a look at what the actual markets are doing. Well, European stocks in here, and we've already looked at that piece of data. So look, the French economy, going back to that piece of data in here, this piece of data from France in here, the French GDP number 5.4%, 0.7. Going back here, look, strongest in 52 years. Okay, economic growth, 52-year rebound in here. But remember, that's rebounding from the post-pandemic situation. So. But strong data in here. There's the article there. But if we go and take a look at what the indices have been doing in here, so we're down, kind of stuff. So we did get the rebounds yesterday on the European closes. Markets were looking strong. We had the sell-off, the latest sell-off in the US, and then that's dragged European equity indices down, on the cash equity indices down this morning. If we go and take a look at the US side in here, so let me go into here. And what we'll see is the markets in here. So the stock index futures in here, not significantly down, but nevertheless down. So the Nasdaq's not down too much at all. S&P 500 though down 0.75%, and we're down nearly 1% on the Dow. So significant setbacks. And then again in here, they're focusing their stocks up again. The January route rumbles on. And then in here as well from morning bid transatlantic split. So in here, I think this is talking about where are we? Oh, they're talking about the bond yields in here, and the fact that we're seeing a significant shift in bond yield differentials, and so the dollar index, the dollar is definitely benefiting from that, because we've got a far more hawkish, far more hawkish tone. And even though, look, France just posted data showing the economy is expanding, we've already looked at that. Sweden too, beat expectations of 6.4%, but at the moment the European central bank's not showing any kind of sign in here of any kind of sign at the moment of well, the UK is where there's, I think we've got 4 rate hikes built in at the moment, 4 expectation of 4 rate hikes in the UK, but at the moment Europe not building, in the ECB not expected to increase interest rates to any kind of significant level in here, or if at all, into 2022. And so that means we've got still a wider interest rate differential between the US and Europe, and hence and also globally as well. We're seeing dollar yen as well. So the dollar's rallying across the board. And if I've got it on the, I'm just going to come out of this one, looking at the equity markets here, but we have been looking at the dollar, and if we go and look at the dollar in here, look, so it was charged higher yesterday. I said it was difficult to buy. We were just above these peaks when it came on yesterday. If I go into a 1-hour chart, so when we were on yesterday in here, let's go back to 12 o'clock yesterday. That's 12 o'clock my time, that is. Okay, so 12 p.m. So there, look, so we were about here. So the market did manage to go notably higher, and then has gone notably higher again, even though it felt very, very, very overbought when we looked at the daily chart yesterday. If I go back to the daily chart, you see the market's very stretched, So as overbought as more as overbought as we were here, look what happened here. As overbought as we were here, okay, look what happened here. The market went kind of set back and then went sideways for a bit. So probably looking for the dollar to stall in here. It's really difficult to advocate buying it at the moment, but then, you know, I wouldn't want to be going short at the moment either. So, but just watch out for this dollar potentially turning, because it is very, very overstretched in here at the moment. Let's switch back and take a look. Actually, while we're here, we'll just take a run through. I'll just pop that one back up again, and then we'll take a look at oil and gold. So oil in here, pushing to another new high, setting back and then dipping and rebounding overnight, rejecting this previous setback we saw through mid to latter January. Looks bullish in here to me. I can only play this from the long side. You know, every dip in here has been bought, and you know, we've got a really shallow dip and a rebound already in here this morning. And if you step into the 1 hour chart in here, so we've got a kind of sideways consolidation in here over the last 24 hours or so, but the market, you just dip below these lows here and here, but you can see as soon as it dipped below those lows, it looked like a topping pattern and then straight back higher and then dipped overnight in here, and then this morning already rebounding. I think if we get above this little peak in here, so this is on the March crude contract, if we get above the high there, 87.58, that's a buy signal for me, and then back up to the highs in here, up to 88.5. So there's a trigger through there for you today. It's only negative if it goes all the way down through there. I wouldn't even want to be selling it down through there. So it's in a consolidation pattern. You could argue it's a head and shoulders forming, but at the moment, I think you still have to play this from the long side. Let's take a look at gold, which continued to plunge lower yesterday. So we had this kind of break of the trend line, broke down through this lower trend line. We spoke about selling down through that low there yesterday, and so that low there, that would have been a good trade there. That low there, we were above that 1804.7, significantly lower. Again, lower again today, and we went down through this low, just nudged below this low in here. That low there, 1781.3, and we got down to, actually not quite through that low, 17. Oh yes, we were. Yeah, 1778.9. So we just nudged through this low in here as well. From that's from right at the beginning of the year. So that's the low point of the year. So we made a new low for the year. This looks a lot more negative. So certainly more downside pressures are expected to continue today. And we've had an intraday bounce in here. So if I step into the a 1 hour chart on gold. And there's a little rebound we've got going on right now. You can see, you can imagine the downtrend line coming in. Found it, lower lows, lower highs, all intact. Looking for this. If this starts to roll back lower, then selling on the break back lower. So waiting for the rebound to finish, waiting for the rebound to conclude, and as it rolls back lower, be stepping in now to something like a 15-minute chart and waiting for now. So you still, you don't want to be selling this, but I think the setup is to sell somewhere in here, and then you're looking at this little up counter trend line. You might even step it right away into a 5-minute chart in here. So you're looking at this kind of up counter trend line and extending that out. And then looking for it to market to break back down for there. And there's your trigger to get in. And it's a really, because then if you enter on a breakdown through this trend line, you've got an obvious stop wherever the swing high is, a stop above the swing high. This could be all the way back down to the lows down here, low 1780s, high 1770s. It could easily be back down here, but waiting for this to run its course in here. And obviously what you're looking for is continued dollar strength to see gold weaken. Let's take a look at those stock indices, because I know a lot of you guys trade those. It has been continued to be really volatile. We're obviously back lower in here. We've already spoken about that. Look at that really erratic. I mean, that doji pattern, this is called a long-legged doji, which is usually a turning point. But is it turning up or is it turning down in here? And you've had these repeated pushes lower. We went even lower again yesterday, but then the day before we made a break above these highs. It's so erratic. You have to be super careful in here. Tight stops, as I say. As soon as you get into a position, if you're making money, tight trailing stop, and then if it breaks this low in here, then I think it could easily test the lows in here. But we're going to probably have to wait until we might get it on the data, the PCE data. But if we don't get a breakdown here through the PCE data, then you're waiting for the cash market open. For me, I'm still wanting to buy this. I'm still looking to buy the dips in here. I think but then if it breaks this low, we could easily be back to this low. Remember, going into the weekend, the conflict in Russia, Ukraine. Do people want to be long risk assets? Do they want to be long equities going into the weekend? So we could see a significant breakdown. Here's the 15-minute chart in here. So it's been a sea of red in here through the European for the European Open, and there's the more recent low in here. So it's looking for it to hold these lows in here on the S&P. Let's take a look at the Nasdaq on the daily first of all. Again, look, so whipsaw yesterday, indecisive doji pattern yesterday, and then back lower, almost sitting on yesterday's lows. If the Nasdaq takes out the low here, particularly with the good Apple data we've had, we had good Tesla data, even though some of the guidance, the concerns around supply chain worries, is a concern, obviously. But we've had pretty strong tech data in here, and the Nasdaq continues to fall. Obviously, getting hit in here, the Nasdaq getting hit because it's growth stocks, and growth stocks get more damage when we're in a both inflationary and potentially a higher interest rate environment, and that's where we're moving into. So so there is still downside risk in here. I will say we're sitting right on yesterday's low. Yesterday's low there is at, let's just make this a bit bigger. So yesterday's low 13,856, and we bent down to 13,860 and just trading just above there right now. Again, I'm a dip buyer on this one, but if it starts to break yesterday's low and it goes and hits this could be capitulation. We could see this another 2-3% down. In this environment, you cannot get tied to a position, to a positional view. You cannot just be adamantly bullish. If it starts selling off and you were bullish and it breaks levels, support levels, you can flip and go short because the market's charging in just one direction, but then quickly flipping. So that's why you need to trail those stops quickly if you do get into the money. I'm going to wrap it up there, guys. I'm going to wish you all, as ever, a great trading day. Please do stay safe out there. Have a great weekend too. I'll be back with you on Monday for another bull versus bear webinar. Until then, stay safe. Take care.